Good morning. Welcome to this installment of Pro Bono Partnership of Atlanta's monthly webcast series. My name is Sarisha Gunta. I'm an attorney with the partnership, and today we have Mary Benton with us, a partner from Alston and Bird, and she'll be speaking to us about galas and silent auctions. This is part one in a series that we are presenting on fundraising options, galas, tournaments, and festivals. Oh my. We're hoping to cover some topics generally that are relevant to silent auctions and galas, but we're going to be focusing primarily on some recent changes that the Georgia Department of Revenue has provided related to sales tax and how that relates to galas and silent auctions. I want to first give you a little bit of information about Pro Bono Partnership of Atlanta before Mary goes into the details of today's presentation. Our organization's mission is to provide free legal assistance to community-based nonprofits that serve low-income and disadvantaged individuals. We do this by matching these nonprofits with attorneys at Atlanta's law firms and leading corporations to provide free business legal services. Our clients are typically 501c3 organizations based in Atlanta who serve low-income and disadvantaged individuals and are otherwise unable to afford legal services. If you're interested in learning more information about our organization or in applying to become a client, you can visit our website and our application is there. And also on the website, we have a host of great resources, including articles, past webcasts, and in a few days, this webcast will also be there. And please keep in mind that the information that Mary will be sharing with you this morning is just general guidance. If you have specific questions about your organization, please reach out to your attorney. Thank you, and thank you, Mary, for sharing this info with us today.
Great. Thank you so much, Sarisha. I really appreciate it, and I'm glad to be here and participate in this webcast. This is I think the first of three that's going to focus on different fundraising techniques typically used by nonprofits. And the genesis, as was stated a little bit earlier, is that several tax attorneys here in town have been working with the Georgia Department of Revenue to try to promulgate a policy bulletin that will further kind of clarify how sales and use tax should be applied within the concept of nonprofit organizations and specifically with fundraising events. And so the information that I'm going to share today starts out kind of generally about the sales and use tax and its application generally to nonprofits, just kind of a background, lay the landscape, so to speak. And then we'll be talking about silent auctions and galas and sales tax associated with those. And the guidance that is provided today is based on the current draft of a proposed policy bulletin. It has not been issued by the department yet. We don't expect it to change, but it, anything is possible. But we think this, what I'm providing you is where we have landed so far. So let's get started just with a brief overview of sales and use tax. The sales and use tax is a transaction-based tax. You all know every time you go into a store and you buy something that's taxable, you pay a sales tax. The tax is imposed on tangible personal property, on certain services, although not very many in Georgia. And then for purposes of these admission events and galas and auctions, it's also imposed on sales of tickets, fees, or charges for admission to places of amusement, sports, or entertainment, and that becomes important later on. The tax does not apply to a sale for resale. This is typically done in a business context. So if a business purchases items and then are going to resell it, they can give a resale certificate to the seller and then they collect the tax when they resell that. So that is a specific exemption that is provided for in the law, generally in Georgia and throughout the country. The use tax I won't talk about a lot, except for in the context of internet sales, or as we call it, remote sales. So the use tax is a complementary tax to the sales tax, and it applies when the sales tax has not been imposed. So if you purchase something, just in general terms, over the internet, and you think, aha, they didn't charge me tax, it's tax-free. Well, unless an exemption applies, it's really not. That seller just is not required under the Constitution, basically in the Georgia statute, to collect tax from you. However, the purchaser is still liable for that tax. And you are supposed to self-report, and there's a little form that you can do that in Georgia. I don't think very many people, other than probably state and local tax attorneys, do that. But it is complimentary. It's becoming more and more common that tax will be imposed on these internet sales, just because of what's happening in the country and in Georgia, and that's a whole other story in a webcast for another time. Moving on, there are certain exemptions from the tax. The seller does not have to collect the tax if an exemption applies. However, many nonprofits, particularly when you're starting out, sometimes believe that because you are a nonprofit and you do not have to pay income tax, if you are a 501c3 or 501c4 and you have an exempt determination letter from the IRS, that you don't have to pay sales or use tax, and that is not the case. There is no general exemption from sales and use tax for nonprofit organizations. On the contrary, there are 99, at least to date, specific exemptions that are set out in the Georgia Code. And if you're really curious, it's in section 4883. It's about 30 some odd pages of text with 99 specific exemptions. And some of those do apply to certain nonprofits and charitable organizations or schools or governments, things like that. There are basically three types of exemptions. One is based on who the entity is, who's doing the purchasing or making the sale. Those would be like state governments, local governments, certain hospitals, certain health institutions, and things like that. The second is the type of use that the property is going to have when it's purchased. And an example of that could be a purchase that's used exclusively for educational purposes, or manufacturing is another one of those. If you are going to, there's a big manufacturing exemption that applies specifically to how that's used. And then the third is the product, so the type of product that is purchased. So prescription drugs, durable medical equipment, things like that. They're specifically stated as a product in the statute. So unless one of those exemptions applies, or unless you have a sale for resale, then you, as a seller, are required to collect the tax. So the tax is actually imposed jointly and severally on the seller and the purchaser, but the seller has the burden to collect the tax. Unless you get a properly completed certificate, which has a sales tax number on it, and you take that certificate in good faith. And so that means that you have reason to believe that that application or that certificate is given in good faith. So, for example, if you made a sale of durable medical equipment and you made it to, Tootsie's retail store, you probably shouldn't take that because they're probably not selling durable medical equipment. So that's what good faith means in that concept. So how does that apply to nonprofits generally? Generally speaking, unless one of those exemptions applies, all purchases that are made by nonprofits are subject to tax, and then all sales that are made by nonprofits are subject to tax. So you have the obligation to pay the tax on your purchases and to collect tax on your sales. If you are responsible for collecting the sales tax, then you should state the amount of tax on your invoice. You should collect it from the purchaser, and then you remit that to the Department of Revenue. The sales tax rate is based on a state rate of 4%, and then a bunch of different types of local rates. And so there's 159 counties in Georgia, and every county and then every city and locality is allowed to have its own tax rate. So in the city of Atlanta, it's 8.9% right now, which is the highest one in the state. But then you have, Cobb County, which is lower than that. And the rate of the tax is going to be dependent upon basically where the sale takes place, or where that property or is delivered, or that service is used. And we'll talk about that in the concept of galas a little bit later on. So that's kind of just a basic overview of sales and use tax. And, as I said, that I've given speeches on sales and use tax where we talk about all of that, and it covers an hour. There are a lot of permutations that go on to that, but generally speaking, the main takeaway from that is that nonprofits are subject to the sales and use tax rules, and there are certain exemptions that might be applicable, but they are going to be determined by statute. So turning now to the fundraising techniques. The first one we'll talk about is a fundraising dinner or a gala. And so this is something that is very common in the nonprofit charitable world. Your organization is going to want to raise money, and so in order to do that, you're going to have an event. There's likely going to be food and drink that's going to be provided to the attendees that's going to be complimentary to the attendees once they purchase a ticket. And you may have a program or a presentation or provide certain types of entertainment. You're going to sell tickets to that event for individuals to attend, and you're going to set a ticket price. And so on that, the question then becomes, is sales and use tax applied to basically that charge or that ticket price for the gala? And if so, what's the basis of that tax? And so here's where we've landed currently. So right now, let's have an example that will make it a little bit more obvious. So let's say the ticket is $100. You're basically going to collect tax on the fair market value of the food and drink that's provided. So you determine pretty much the same way that you're going to determine for federal income tax purposes, to determine how much is cost of goods and services and how much is a deduction for federal income tax purposes. You can use that same breakdown. And so if of your value of your $100 ticket to attend the gala, if $40 is the amount of food and drink, so that's the fair market value of your food and drink, and $60 is a donation, then your organization or the nonprofit should collect tax on that $40, the fair market value of the food and drink. And really, so we'll come back to that. So basically, if you've determined that the food and drink value is $40, the donation is $60, you're going to collect tax on that $40. There's also the issue of food that's then purchased to serve to your attendees. And if you are working with a caterer and you're purchasing the food and drink from a caterer or a vendor, then you as the nonprofit can buy that food and drink as a sale for resale. So remember, we talked about that's one of the transactions that's not taxable. So you have a resale certificate that's an ST5. It's on the Georgia Department of Revenue website, and you can provide that to your vendor or to the caterer, and you're basically saying, don't charge me sales tax now because I'm going to be collecting sales tax on the ticket price. Now, some of y'all who are really lucky, you might get food and drink donated at your event. And in that case, the caterer or the vendor who's donating that is responsible for paying the sales and use tax on that food and drink. And it's not a sale for resale in that context, so they're responsible and liable for self-assessing and remitting that. So how do you effectively calculate and remit the sales tax? And there's two different ways you can do it. One, you can say, okay, in our example, $40 is the food and drink, and so I'm going to calculate sales tax on that $40, and I'm going to collect that and add it to the ticket price. And so if you do that, let's just use an 8% sales tax, then that's, what is that, $3.20. And so you would charge $103.20 for the ticket, and you would keep the $100, you would remit $3.20 to the Department of Revenue. The other way you can do it, which is a little more complicated for you, but it's a little more seamless for your guests or attendees, is that the sales and use tax can be included within that $40 that's been determined to be the fair market value of the food and drink. So if you're doing that, you're basically making kind of a backwards calculation, and you're backing out the sales tax and the amount of the food and drink from that $40. So for example, as you can see on the slide here, we've used the City of Atlanta sales tax rate, and we've calculated that at how much of the $40 is 8.9%, and that's $3.37. So that's the tax, and then 36.73 is the food and drink. So in that case, you can just charge $100 for the ticket. You're keeping what is that, $96.73, and you're turning $3.37 over to the Department of Revenue for that. So in order to do this, obviously you have to have really good records. So you want to keep that and keep those records. And you also need to publicize how you're doing the sales tax breakdown at your event and on your website. And so you want to say that the $40 is inclusive of tax and tax will be remitted, or you want to say that it's $100 plus tax, and that you're going to be collecting on that $40 fair market value of food and drink. So you just want to be clear, and you want to make sure that that's publicized both probably on your website when you're selling the tickets, on a flyer if you're selling the tickets, utilizing a mailer or an invitation, and then also at the event. So one caveat on that, and this is something that we went back and forth with the Department of Revenue, but if entertainment is provided, and let's say it is a string quartet or something like that, you don't have to include that in the value of the goods and services that you're providing at the event. However, if it's entertainment that you would otherwise most likely pay to see, so you would buy a ticket to go see that form of entertainment. So let's say in Atlanta, Yacht Rock Review, right? Yacht Rock Review comes to Atlanta, it comes to certain venues, I can buy a ticket, I'm charged sales tax on my ticket when I buy it just to go see Yacht Rock Review. If my charity gets Yacht Rock Review to come and play, and my ticket price is going to effectively include food, drink, and a ticket to see Yacht Rock Review. So you have to collect the tax on the value of that ticket for Yacht Rock Review. Excuse me, the cap though is the amount of the ticket price. So let's say your ticket price is $100. You can't be forced to collect tax on more than $100. So in this case, let's say that you could go see, Yacht Rock Review for $25 and the food and drink is $40. So you'd be collecting tax on $65 and $35 would be a donation. If you're really lucky and you get Elton John to come play at your thing, you're probably going to be collecting tax on the whole $100. Again, just keep very good records and the base of how you determined what the taxable value is. So moving on, that covers the admission to get into, or the ticket price to get into the gala. And then many of these events have a silent or a live auction or some combination of both. And you all know the drill. Nonprofits will receive donations of items, and those can be anything but a pair of tickets to the Falcons game, an autographed football, dinners at different restaurants around town, a spa massage basket, a piece of art, things like that. And so you get donations, to your organization, and then you put those up essentially for auction at the event. And on those, the question is, do you have to collect the tax? And if so, what's the basis of the tax? So on the next slide, before we get to that, we talk about the people who are actually giving you the donation. So if someone goes out and buys something and then donates it to you, they should pay the tax on that. So it's two different transactions, so the sale for resale doesn't apply. And then businesses, sometimes you'll go solicit a business and say, will you donate, like a salon or something, will you donate some hair products? Then they should pay the tax on that when they withdraw that from the inventory and give it to you as a donation. But back to what the nonprofit organization has to do. You have to collect tax from the winning bidder. And then the question becomes, what's the basis of that tax? So you have to collect the tax because, as we talked at the very beginning, the sales tax applies to retail sales, and this would be a retail sale. Someone is making a purchase of an item, and you are the one who's effectively selling that item, and so you have to collect the tax. The tax is due on the fair market value of that item that's purchased. And this is very important. On your bid sheets and in advance, you need to determine what is the fair market value of that item. And so if I'm auctioning off this coffee cup, and let's say it's really special, I could say the fair market value is, $8 or something like that. And let's say that the winning bid is $20. So someone bid over the fair market value. Then I'm going to collect tax just on the fair market value of the mug, okay? And so I put myself in a box here because now I have to calculate sales tax on $8. So anyway, let's do an autographed football. Let's use that example, which I think is the example that's going to be used in the policy bulletin. So let's say there's an autographed football and the fair market value is $200, and someone really wants it for their kid's birthday and they pay $500, okay? You're going to collect tax on that $200. And the way you're going to do that is the same way you did it for the ticket price. So you can either charge sales tax on that $200, you charge $216 of tax, and $216 including the tax, and you'd subtract that from the $500. And so there you'd have a taxable sale, $216, and a donation of $284. You can do that all on one ticket as long as you're clear that it's $200 of a taxable amount, $16 of tax, and $284 of a donation. Or you can do two separate invoices, basically. One for the football, $200 plus $16 of tax, and then one for the donation, $284. Let's say that you have an autographed football, but it's from some guy that no one knows and they never saw him play, but still they wanted it because it could be kind of cool, but it doesn't go for the fair market value. It only sells for $150. So it's less than the fair market value of the item. There you have to collect tax on the full amount of the winning bid, so on $150. So there, the person who wins would be paying $150 plus 8% sales tax on that. So your invoice would say $150 plus the 8% tax, and the total amount is what you would collect from that, and you'd remit the tax to the Department of Revenue. Another complication that can arise, or just, more, not a complication, a complexity perhaps, is if you have what we call in the sales tax world bundled transactions. So that is things where some things are taxable and some things are not taxable, but you're selling them for one price. So in that context, you would collect tax on the taxable items and you wouldn't have to collect it on the non-taxable items. So an example of that would be the spa basket. Let's say you have 4 massages that are included and $100 worth of product. So you have a fair market value of $500 and someone bids, let's say, $1,000 for that. So you would make sure that you're collecting tax on the $100 of the spa products. You would not collect tax on the $400, and you would have a donation of the $500 less $8 for the $100 tax. So let me say that again. $100 is taxable spa products. $400 is massages that are not subject to tax. $500 is a donation. So you would be collecting $108 effectively towards the taxable products. You would collect the $400 of the non-taxable product, and then you would have $492 as a donation. And so you could do that all in one ticket, or you could do it in two tickets. The real takeaway from this is to be very clear on your documentation, what you're doing and what you're collecting. The rate of the tax that you're going to collect is for a silent auction is where, and for the ticket price, is where the event is being held. So even if you're an organization that is located in Cobb County, if you're holding your event in the city of Atlanta, you're going to collect the city of Atlanta tax. On vacation homes, sometimes if we're fortunate enough to get the vacation homes, those are going to be taxable if the house is in Georgia, but not if it's not in the state of Georgia. Again, you want to keep really good records, and you want to determine the fair market value ahead of time so that that you know what the base of the tax is going to be. I think it's also probably a good idea on the bid sheets to say that tax is going to be collected on the fair market value of the item that's purchased by the winning bidder. The last slide, additional items to consider. If you are hosting a raffle, you have to have a license to have a rifle. Oh my goodness. I need more of this. You do probably have to have a license to have a rifle, but I don't know much about that. But to have a raffle, you have to have a license. And so you're going to want to click on here on how to obtain a raffle license. That is a tongue twister. See, she sells seashells. With respect to sales tax on raffle tickets, let's say that you sell your ticket to your gala for $100 and everyone who comes gets a raffle ticket. Then you don't have to charge additional sales tax on that raffle ticket. It'll just be what we talked about for the fair market value of the food and drink that's offered. However, if you are selling raffle tickets for the event, at the event, and they cost $10, then you do have to collect the tax on that raffle ticket. And you can do it the same way. You can include it within that price of $10 and let everyone know that, of that 80 cents or whatever it would be is the sales tax, and $9.20 goes towards the raffle ticket, or you can tack it on top. It's your choice. Again, keep good records about that. If you're going to selling or have alcoholic beverages, you may have to apply for an alcoholic beverage permit, which is also through the Department of Revenue. So you need to look into that. And of course, you should always make sure that your insurance policy would cover anything related to your auction or gala, and just check your insurance policy with your agent. So I think that gets to the crux of what we were going to talk about today. I know we've been taking questions, and we had some questions that were submitted earlier. I'm also happy to run through the kind of fundamental calculations again, because I know it was a little, anytime there's numbers involved, it's a little tricky. I will also say that that Robin Miller and Richard Litwin have written a great paper related to this, and it is on, I believe, on the Pro Bono Partnership website on that, and certainly once this policy bulletin is publicized, we'll be making that known as well.
To start with, we have some questions related to how to determine a fair market value. For example, if it's a handmade item, do you have any guidance in terms of how to determine what a fair market value of an item like that might be?
So, yes, so we also have had talks with the department about this. So if it is a handmade item, or let's say it's if it's an item by an artist, let's say, and it has a known fair market value that they would sell it for in a gallery, then that would be the fair market value. Let's say that though you are a nonprofit that that one of you do art therapy or something like that for your clients or your guests of your nonprofit. And so they make items during the, during the month leading up to the auction, and you're going to sell those items. So, I bought a sculpture once that was made by a kid in foster care at the bridge, right? And it was through the art therapy project. That the fair market value is basically going to be the price that the winning bid goes for. And so that, basically is if someone is willing to pay $100 for that, then that's the fair market value for that. And the basis is that fair market value is generally defined as, the price a willing seller would, the price a willing buyer would pay and a willing seller would accept at an arm's length bona fide sale. That's the definition for tax purposes of fair market value. And so and it's the amount of consideration that is received is effectively your sales price there. So if you pay $100 for that item, even if it only costs $8 to make, then that's going to be your fair market value.
Okay. And can you speak a little bit more about what is considered taxable or not taxable? For example, spa products are taxable, but what about the spa services?
Okay, so that's where at the very beginning when I talked about what the sales tax is imposed upon. So the sales tax is imposed upon tangible personal property and then certain services, but not all services. So most personal services like spa services, massages, manicures, pedicures, things like that are not taxable by the Georgia Code. So in another, let me put it a different way. In Georgia, no services are subject to tax unless they're specifically taxable by the Georgia Code. Okay, and so there's only certain of those that are. I think moving services might be subject to tax, things like that. So they're specific in the code, and so there, the best way to go about determining that is whoever donates the items to you, just ask them, do you collect tax on this? And that's the best way, because if they're collecting the tax, then you should be collecting the tax. And if they're not, then you wouldn't have to. That's the best way to do it. You're welcome to dig through the Georgia Code as well.
And what about auctions that are outside of a traditional in-person environment, like if it's on online platform?
Sure.
An app?
Okay, so same thing would apply. So a lot of times, you have the app that's listed, and so you don't have to go around and write on the bid page. So you can just do it, which is great because people get competitive and you don't have to get up from your table to bid on the item, or you can do it remotely. So let's say I can't go to the event, but I really want that autographed football. So I can be, somewhere else having dinner at a friend's house or something, and I can be bidding on that item. Sales tax is collected in the exact same way. And so if it's a taxable item, so in our example of the autographed football, let's say the winning bidder is actually someone who is not present at the auction and they won through the remote app, then you would collect sales tax the same way. And the invoice that you would probably email to them should state that the football was taxable at $200, $16 of tax, a $284 donation. So it's the same thing.
And what about, could you speak a little bit again about what happens when an auction item is sold for below fair market value?
Okay, sure. So in that case, The simplest answer is that the entire amount that was paid is subject to tax. The only difference there is that you're going to have to actually collect that tax on top of the amount that the bidder paid. So if the football fair market value is $200 and someone bids $150, and that's the highest bid, then you're going to take that $150 bid and you're going to calculate the sales tax on top of that. So because I'm lazy, I'm going to say the sales tax is 10%, and that would be $15. And so you would actually be collecting $165 from the winning bidder. You'd be keeping $150, you'd be remitting $15 to the Department of Revenue. And that's why on your bid sheets, you should say that, all winning bidders will pay tax on the fair market value of the item if they win that bid, so that it's not surprised at the end.
And what about reporting obligations? If you hold a gala with tax reporting responsibilities, do you have to file monthly sales tax returns, or how often do you have to report?
Okay, so that depends on if you are required to be registered with the Department of Revenue or not. If you are an organization and you're already registered with the Department of Revenue and you're already collecting sales, like let's say you have a gift shop or something like that, or you're selling t-shirts and you're collecting tax on that, so you're already registered with the Department of Revenue, then you would just collect the sales tax from your gala and you'd include it on your next return that you make to the Department of Revenue. If you are a nonprofit organization and you generally make no retail sales, so you don't have a reason to be registered with the department for sales and use tax purposes, then you would effectively remit that on a one-time basis. And so there are different forms that you can use that are on the Department of Revenue website. There's I think a paper form, and then there's an electronic remittance through the Georgia Tax Center, but you can get that information off the Georgia Department of Revenue website.
And a question about charging taxes on an item that you already paid sales tax on. If you paid tax on a purchase item and then auction it off, do you have to collect and remit sales tax at that point too?
Yes, you do. And the technical reason, if you want to know, is because you didn't make that purchase for resale effectively, right? You made that purchase and then you decided to auction it off. And so there's two different transactions.
And in terms of online transactions, what jurisdiction would that payment fall under if you're having online bidding?
If you're doing online bidding, then you would, that's something that we probably need to talk to the Department of Revenue about, because, technically the answer is where that, the receipt or the delivery of the item is. And so I think we need to talk to the department about that and clarify that, and I'm going to make a note to talk about that. However, I would say for purposes of this, that you should collect the tax that at the rate where the event is being held. I think is probably a safe determination unless we come up with something else in the policy bulletin. Because one of the things too that we've been working with the department, and I will say they've been wonderful at working with us, is just to have clear rules that are easy to follow and that make sense, right? And so we'll talk about that. I don't want to go into the complications that could arise.
And could you provide some guidance in terms of the practical aspect of how do you, if you're having an auction and that night you're trying to deal with the paperwork, how is it okay to do that after the fact? Do you have to do that the night of the event in terms of collecting the sales tax on that evening, or can you reach out and collect it later on from the auction winners?
So if you are accepting payment for the items that night, then you need to collect the tax that night.
Okay.
And so beforehand, you can also have like a chart or something like that, right? And so you've seen maybe like at some stores where they have big like clearance sales or something like that, and they'll have a chart and it'll say, was $20, it's 20% off, so now it's $16 or something like that. You can have a sales tax chart with you that you can give to everyone who's checking people out. And let's say you're only taking bids in increments of 10 or something like that. So then you can have a sales tax chart that would have, if it's $10, if it's $20, if it's $30, if it's $200, $210, $220. So then you're not on your phone doing a calculation, but you just are looking at that chart. So if the winning bid is $200, then you know that $16 is tax and the rest is the donation. So you're doing that right then. I'm not really aware of any software that's been invented for this type of purposes. So I don't know. Maybe that's yeah, there you go. But there's an app for that. But I would do that and just train the people who are doing that. Now, that said, let's say that on the winning bid, if it's over fair market value and you charge someone and you pay them $500 and you just give them a receipt that they made a bid of paid $500, you can correct that later. So let's say you're going back through and you're like, oh gosh, this football costs $200. There's tax on $16 that I have to remit, but I gave them a receipt that said they paid $500 with nothing else on that. You can fix that. So you then can send them a receipt that says, $200, $16 of tax, a $284 donation, and then you can use that to do that. Now, let's say that for like a bid where it's less than fair market value and someone didn't collect the tax, you can go back and collect it from the purchaser. I would probably say that's probably not the best idea in terms of, hey, thanks for bidding and we forgot to collect the tax from you and you owe us $16 more. In that case, you would be responsible for the tax and you would just self-assess $16 and send it to the Department of Revenue. So there's ways to get around it if you, don't collect the tax at the time. The easiest thing to do would be to do it that night of, and there's probably some tools that you can do to be prepared in advance. There's probably some other ways to do it as well. If you, talk to, an attorney, something they might be able to help figure out some different ways to do it.
Well, that's all the questions we have today. Thank you, Mary.
Okay, great. Thank you.